Okay, well, hello everybody. As I promised in class on Thursday, I wanted to do some just a few problems in the back of the chapter for chapter 14, since the due date for these for the homework quiz and bonus is going to be on Sunday the 29th. I've also made some changes to some other due dates, and you can go into Brightspace and notice those. Just to give you a really brief rundown, and I'll talk more about these as we when we come back to class on Tuesday. But I've extended the due date on the exam to let me see here, to the 5th. I know that's Easter Sunday, so if you want to sort of budget your time and whatnot, but that'll be the only thing due next week is going to be that exam. So you can do that whenever you like up to the 5th. Also, so you have the incremental analysis, which is the chapter 14, which I'm going to talk a bit about here, and also the case study due this Sunday as well. If you need a little bit more time with the case study, just let me know. I mean, a few more days. I wouldn't try to stretch it out. And then I've pushed the due date for chapter 15 to the 12th. So that's good, because we're going to start chapter 15 in class. It gives us a couple weeks to talk about budgeting and analysis. It's a pretty important chapter. And then after that, we only have one more chapter. So there are only two more chapters left in the course after you complete chapter 14. That's chapter 15 dealing with budgeting, and then chapter 17 dealing with standard costs and the balanced scorecard. You'll also have one more case study as well as the final exam. I also pushed the due date for the case study to the very last day of the semester, which is April 26th, and you will definitely want to get it in by April 26th, because that is the end of the semester, and there's just no more time after that. So you want to make sure you do that. And the due date also, the final exam, I'd indicated it was April 22nd. I'm not sure who put that. I didn't design the course, and so I actually moved that to the 24th, which is Friday. And I do want to get that in before the 26th, mostly because invariably something happens in the very last week of finals. There are a lot of people on the system using Brightspace. It's usually not a problem, but sometimes, there are, volume issues and whatever. So it's something to consider. So if you could get that in before the 24th, you should be fine. And again, all these are indicated. I've noted them all in Brightspace. And if you have questions about any of these individually, well, let me know, and I'll be more than glad to talk about those. So, all right. Well, I wanted to take a look at, I'm going to do a sampling of about 3 different exercises from the back of the chapter, just because we didn't have time. We ran low on time on Thursday. And so the first one I want to do, and by the way, I wanted to do ones that did not have the answers, with the little blue tabs and whatnot. And I also wanted to get a kind of a sampling just to kind of show, what's going on here. So the first one I want to do is exercise 14.2. This is page 14-29 in the e-text. If you have the physical text, I don't honestly know what that chapter number is, but it is exercise 14.2, the Gruden Company. And they produce golf discs. And this might be hard to see, and I understand that in the video. We've got some limitations, but at least you can kind of look at yourself as on your own if you like. So they make golf discs, which it only sells to retailers for $7 each. Cost of manufacture to 20,000 discs. Now, remember, this is the current volume, and we're going to use this as the denominator in order to get the cost per unit based upon direct materials, direct labor, and overhead, which is split into 2 pieces, fixed and variable. So variable overhead and fixed overhead. So, and then they incur a 5% sales commission on each disc sold, which I don't know is that big of an issue here. And now that this is a special order, McGee Corp offers Gruden $4.80 per disc for 5,000 discs. Now, at first glance, and again, this is, as I noted in class on Thursday, a lot of these scenarios are sort of potentially counterintuitive, because you're thinking, okay, wait a minute, we're selling these for $7, and now you want to pay us $4.80 for these, and at first glance, you'd say, take a hike. We don't want to do that deal. But let's look into it. So McGee would sell the discs under its own brand name in foreign markets. That's the buyer. And again, they go out of the way, the authors go out of the way to make sure that it's understood that these are not going to interfere. This is not going to cannibalize the existing market share of Gruden. This is going to go to a different market, foreign market altogether. And if Gruden accepts the offer, they'll incur a one-time fixed cost of $6,000 due to the rental of an imprinting machine. Now, this is a case in which the overhead will change, and we need to understand that. Now, in some of the scenarios that we saw previously, we said the overhead won't change, but in this case it will, but we can factor that in and work with it. And so let's do that. And I know this is going to be a little bit challenging just because of the limitations that we've got here with regard to board space, but I'll do the best I can. And the angles aren't perfect, but hopefully it'll be easy to see what's going on. So this is exercise 14.2. And again, we're going to come down to the idea of do we do the deal or do we not do the deal? And it's not a case in which we're going to renegotiate or anything like that. It's going to be, we're going to either reject it, which is what we could do, and it looks like that might be what we do, so reject the order, or do we accept the order? And we're going to lay out the case here, the cost case, as well as the revenue. And we're going to talk about the change in net income. And of course, the little delta symbol here everywhere in the sciences refers to change in something. So first of all, let's just take a look at what the effects are going to be on revenues, and then we'll get to costs. So let's look at revenues first. If we reject the order, the incremental change in revenues is going to be nothing. If we accept the order, we're going to sell 5,000 discs at $4.80. And so if you just do the math, price times quantity, 480 times 5,000, we're going to earn 24,000 in revenue. So this contribution to net income is going to be a positive 24,000. We haven't gotten into cost yet, so let's get into cost. Let's take a look at the effects on direct materials, direct labor, variable overhead, and fixed overhead, which we're going to sort of split into two pieces here. And so what are we going to do? Well, first of all, let's just go all the way down. If we don't do anything, the effects on this is going to be zero, and so as a result, there's not going to be any sort of effect whatsoever. So in this case, the change in net income is going to be zero. So just because of the fact that if we reject it, there's not going to be any change, okay? Which we can do or not do, all right? Now, this is where it gets a little bit tricky here in the sense that we need to compute the cost per unit, not the price per unit, because we know it's $4.80, but the cost per unit. And how do we know what the direct materials cost is? Well, we go back to this current capacity for 20,000 discs. If we take $10,000 for direct materials, and we're assuming these are direct materials, divided by 20,000, we get 50 cents per unit of a cost allocated to the per unit cost of these. And so that's $2,500. And so that's going to be a negative. And so we're going to include that there. The same logic goes with labor. We take $30,000 for labor to produce 20,000 discs. 30,000 divided by 20,000 is, what does that come out? It's $1.50 per unit times 5,000 units is going to be $7,500. And so that's cost. Remember, these are cost of doing business. These are incremental costs for this incremental revenue. Okay, we're going to compare them. And then variable overhead is pretty straightforward. $20,000 to produce 20,000 units. That's $1 per unit. So that's $5,000 for the 5,000 units we're producing. And then when it comes to fixed overhead, we're going to have an outlay of $6,000. Okay, we haven't really seen this much yet. This idea of the change here. And so in this case, what do we have going on? So the effects are going to be, you can carry this all the way over if you like, 7,500. And we'll do it sort of vertically as well as horizontally. And what do we end up with? And at the end of the day, we're going to have this 24,000 minus, this is going to be 2,500 plus 7,500 is 10,000. That's 14,000 minus 5,000 is 9,000 minus 6,000 is 3,000. And that's a positive 3,000. And so the question is, should we accept the order, even given the fact that it's $2.20 per unit less than what we're currently earning or what Gruden's currently earning? And the answer is yes, we should. All else remaining equal, and that's sort of the disclaimer that we like to throw in there, all else remaining equal. Okay, so this is how you would do an incremental analysis. The Wiley setup is going to be fairly similar, and hopefully it's intuitive enough that you can sort of work with it, but just take your time on these. There's no time limit, and as you know, since you've taken 2110 and now 2120, just take your time, kind of think through it, and make sure you're sort of looking at it logically. So that's the first part of 14.2. Part B, well, part B just asks, should we accept the offer? And we're going to say yes. And then finally, C, what assumptions underlie the decision made in part B? Well, I think that the assumption is that these products are not going to be interfering with our existing brands, in existing markets, which is why the authors sort of make a very clear point that these are going to go to foreign markets. They're not going to interfere with the current domestic sales, assuming that Gruden is a domestic seller only. So this is what has to happen. Otherwise, you're selling something at 480. What's to stop them from turning around and selling it for $6 to undercut you by $1? And that's not good. So you'd have to be kind of assured that that is not going to happen. So that's how we work that. And again, as with all of these, if you have questions, I'm going to post this video, and I'll email the link to everyone and also post it in the announcements section. And if you have questions over the weekend, just email me. I'll be available all weekend. I'll be more than glad to work with you on these and hopefully be able to help answer your questions. Okay, so that's the first one, and that deals with a special order. Okay, whether we do the special order or whether we don't do the special order. Okay, let's go to. I want to drop down to 14.6 here, and again, these are ones that are not do not have. And I'm trying to get sort of everything on the one screen here as best I can. Hopefully, this is easy to see. We do have some limitations with the camera angle, but I'll try to do the best I can with that. So let's take a look at 14.6 and what's going on. So the first one we did was a special order. This one is going to be a case of make or buy, and so what do we have here? We have Jobs Incorporated. This is on page 1430 in the e-text. Jobs Incorporated has recently started the manufacture of, it's a robot, and that does whatever it does. The cost structure to manufacture 20,000 tri-robos is as follows. And you can kind of break this out. It's actually very helpful. They've broken out $50 per unit, which is $1 million divided by 20,000. Direct labor, 800,000 divided. So all this. And so total cost to produce the current capacity, the current volume is 20,000. And the question is, they're approached by TN Incorporated, which offers to make the robo for them for $115 per unit, or $2,300,000. Okay, so the question is, do we let them do that, or do we not let them do that? So that's the question that we got to sort of flow out here. So let's take a look at this. This is exercise 14.6. I'm going to go ahead and erase all this. The good news about YouTube videos or any videos is you can stop, rewind, look at it again, whatever you want to do. So that's kind of the beauty here, which is sort of superior in some ways to what we do in class. But so let's take a look here, and let's just kind of see what the issues are right away. So the question is, using incremental analysis, determine whether we should accept the offer, and assume that 405,000 of the fixed overhead can be avoided. So we can't avoid all of it, which is 600,000, but we're going to be able to avoid some of it, which is going to be everything but 405,000. So 600,000, the current fixed overhead cost minus 405 is going to be 195. So let's do this. So let's just we have two different options here. And again, with incremental analysis, we either do it or we don't do it. So we have a make and we have a buy. And let's just kind of take a look and see what we've got here. So first of all, we have the cost for direct materials. And I'm just copying what's really already given in the case here. So nothing new here. Direct labor is 800,000. Okay. And then variable overhead is going to be 120,000. And fixed overhead is going to be 600,000. So altogether, our current cost is 2,520,000, which we already knew. Okay. We already knew that was the case. It's already given. So all I've done is copy that. Nothing different there. Okay. The big question is this: if we buy it, what happens? Well, if we buy these goods finished, and we're assuming these are all finished, there's no new assembly that needs to happen. There's nothing new. There's no ship out, transportation out like freight out or anything. So we're going to have or freight in, I guess I should say. So direct materials go to zero, direct labor goes to zero, and variable overhead goes to zero. But the only part that we still have is the portion of fixed overhead that cannot be avoided, which is 195. And so as a result, that's what we've got going on here. Okay, now here's the thing. So if we take the difference here between 2,520,000 and first of all, let me just add these up here. And I should probably include another line here, actually. And it's going to be the purchase price. I should have thought about that. And so anyway, let's bring this down. 2,520,000. It's going to be zero here if we choose to make current situation. Otherwise, we're going to pay 2,300,000 for these units. And so what is the total cost? The fixed overhead that can't be avoided plus 2,300,000 is going to be 2,495,000. Okay, and compare that against 2,520,000. What do we have? This is going to be the change in net income here, and the change in net income, all else remaining equal, is going to be $25,000. So the question is, should we accept the offer? All else remaining equal, yes, we should. We should accept the offer because it's going to add to net income. And by the way, this is not that unusual of a scenario. In fact, the great management theorist Peter Drucker had long argued back in the day that if somebody else can do something better, cheaper, and faster than you can do, and let them do that, and you can buy it from them, even if it's you start working on something, ship it to them to get more processing work done, they can ship it back to you if it is cost effective because of whatever, maybe it's better technology another party has, or more skilled workforce, or whatever the case might be. Who knows what the issue might be? But in this case, in part in A, it says assuming that can be avoided, and so the answer is, should we do it? The answer is yes. So that's the first part of it. Okay. All right. That's the first scenario. Now assume that none of the fixed overhead can be avoided. Okay. So none of it can be avoided, and now, why? By the way, why would fixed overhead be avoided? It could be the fact that we are maybe leasing some space, some warehouse space, some manufacturing space, where we're paying for equipment. Who knows what the case might be? But if that happens, though, then let's see what the math looks like. So 600,000 then, and we simply rework the numbers here. So we have 600,000 plus 2,300,000. Now we have a different scenario. And so now the total cost to do this, because we still have the overhead, those fixed expenses. And so now what do we have here? Well, now it's a different story altogether. And also there's one other factor we should factor in here, and that's this issue of opportunity cost. And that is, if the robots are purchased from TN, and we can use the released productive resources to generate additional income of $375,000. Okay. Now, what does that really represent here? It really represents an opportunity cost over here. Now, it's not over here, it's over here. So if we buy the goods, it means, or if we don't buy the goods, it means that we forego the opportunity to earn $375,000 in additional income. And so as a result, what does that look like? So it's $2,895,000 now against the $2,900,000. And so what is the change here? If we buy, we're actually going to be losing money, despite the fact that we picked up $375,000 in incremental revenue, which is a cost, an opportunity cost that goes over to the alternative not chosen. And remember, this is one of the things that I know a lot of students who've taken this course have not yet had microeconomics. And the issue of opportunity cost, sort of looms large. It's an important factor, but it's the idea of some alternative not chosen. So it's a cost of doing business if you factor that in. Now, in GAAP reporting in 2110, and those of you who may go on to take other financial accounting courses, not managerial, but financial accounting, this oftentimes doesn't factor in, especially when it comes to historical reporting. It's not an historical cost. But remember, a lot of managerial accounting is forward-looking, and so this is a real cost of doing business. If we choose to make the goods, we forego the opportunity to earn that additional $375,000 of revenue that falls all the way to the bottom line. But yet still, we have a disadvantage, and so now we would not want to do that. And then the qualitative factors, which is the second piece of this, asks, what should we be thinking about? And here, I don't know that you'll be faced necessarily with this kind of a question in the homework quiz bonus type situations in Wiley Plus. But I would say some of the things to think about is, if we buy it, it means we're going to be laying people off. It's usually not very good for morale. Layoffs are not good. Sometimes there's community effects are not good. People don't like to see companies lay workers off, and lay off workers spend less in the community, and so that's a problem. Also, you've got issues of what to do with the capacity you did have. Can you, in fact, get rid of this capacity? Now, by the way, let me just come back to the layoff issue, okay? And that is, let's say that your business picks up over time, and you decide you want to hire workers again for whatever reasons, and hopefully you've thought out what the reasons are. It may not be quite as easy to rehire workers, particularly if you've laid them off. Now, I'm not saying you go back to workers you just laid off. That might not be possible. They may have moved on. They have some bitter feelings. But The idea is you may not be able to hire workers back quite as easily. And the thing is that I know that sometimes people in the business world are sort of attacked for being for making these decisions very in a very cavalier fashion. And that's not really the case. I mean, in the times when I've been in business where we've been involved with the layoffs, management has really agonized over these decisions. And even though it doesn't affect them personally, it does affect them from a just a general standpoint of how it affects the mood throughout the company. So things to think about with regard to that. Hopefully you all can see that. I know the camera angle's bad. This is one of the setup rooms. This is not our normal classroom. This is a room that we use for what we call the Attend Anywhere sections. So it's a little bit more challenging, but if we could move the camera around, we would. But this is not exactly a Hollywood film, so we have to do the best we can. All right. And again, if anybody has any questions about that, feel free to get with me on it. Let's do one more. So we did a special order. We did a make or buy. Let's do one more here. And I want to go down to 1410. This is on page 14-32. In the e-text, let's take a quick look at that. Part of the question is cut off a little bit there. And if I can give you a little bit more room there, you can maybe see more of it. Let's take a look at the question. So in this case, Stahl Incorporated, let me see, produces 3 separate products from a common process costing $100,000. Now, this is a process further or stop question, okay? Again, we're trying to get a bit of a sampling of different types of questions that you're likely to see. And so the question is, there's a split-off point. And remember, in the textbook, we had the example of milk being produced, and then we had cream, and we had I forget what the other product was, but we can stop producing once we have those 2 different products, or we can take them all the way through. One goes to cottage cheese, the other goes to condensed milk. Those are 2 different streams of production that arise out of the same basic inputs. And we see this a lot. And I think the cow example is a good one because there are a lot of products that come from cattle, not just dairy cattle, but certainly with beef cattle and whatnot. So you have leather and you have all kinds of different meats and all that, and all kinds of different uses. So the split off point is the point at which you have to make a decision. Do you stop producing and sell your output as it is, or do you keep on going, knowing that you're going to have further cost incurred, and you got to compare those costs to the benefit that you get and decide if you want to do that or not. So that's essentially what's going on. So in this case, there's a common process cost of $100,000. Now that cost is going to be considered to be not a relevant cost. Why? Because you got to get to the point where all 3 goods are ready to either split or not split. And when I say split or not split, I'm simply saying you process further and then produce all the way to whatever it is your final good is, or stop. And so the costs you've incurred to get to that point are essentially not relevant. It's not that you don't incur them, but they're not really relevant to what the situation is. And so if you take a look here, this is not the easiest thing to kind of figure out, but you've got the sales at the split up point. These are revenues, okay? 60,000 for product 10, product 12, 15,000, product 14, 55,000. If you go all the way to the further processing, product 10 will sell for 190, product 12 for 35, product 14 for 215. But knowing that you've got to incur these costs to get to that point, all here, so 100,000, 30,000, and 150. And so the question is, determine the total net income if all the products are sold at the split off point. Okay, and this is 1410. I didn't write the number on the last one. That last one was I think 14.6. So let's do this and let's take a look. And this one's a little bit lengthier. But I do want to kind of work through this a bit and show you what some of the logic is that is employed in determining what we do. And just by looking at it, it's really hard to know. And this is why accountants use spreadsheets, Excel spreadsheets, and throw things up on it and do all kinds of different scenarios and whatnot. So let's take a look here. So let's do part A first. And all we're simply doing here is arriving at what the situation is in terms of cost. And so we got sales here, and sales are going to be made up of the 3 different products. And so those are going to be 60,000. What is it? 10, 12, and 14. 60,000, 15,000, and 55,000. So together, the sales revenue here is going to be 130,000. Okay, those are the revenues. All we've done is simply added up these values here to get to 130. Okay. And then we have to look at the costs here. The costs are going to be considered joint costs because we're producing all these outputs together, and we're given that it's $100,000. Okay, We didn't have to calculate, we're given that. So as a result, what do we end up with? We have 30,000. And again, like most of the scenarios in this course, we rarely get into things like tax issues and whatnot. So let's not do that. As a tax accountant, I know it's a little bit hard for me not to do it, but in this case, it overly complicates things. And so in this case, $30,000 is net income if we sold the products at the split off points. Okay. All right, so that's really all we've done here. We really haven't done very much here yet, other than take what's given to us. But now let's kind of do a little bit of computation on part B, and that's determine total net income if all products are sold after further processing. So let's go to part B here, and let's take a look at the sales. And here we're going to go to the other column, and we're going to take a look here, and it's the sales are going to be 190,000. And where am I getting those? I'm simply getting these. These are the after production. After further processing cost or revenue, 190, 35, and 215. So let's add these up. 190 plus 35,000 plus 200. I'm sorry, I said 115. 215,000. So together, total revenues are going to be 440,000. So that looks pretty good, doesn't it? It's a pretty big revenue. The question is, what are the costs going to be? And these are the joint costs. Okay. Or well, yeah, the cost of well, first of all, it's the joint costs. That's one cost. Remember, we can't avoid those joint costs. I mean, we have to incur them to get to the place where we are in the first place. And then the additional costs, which we're going to call incremental costs, which are the cost of producing the output to get it to the final place here. And what's that going to be? I'm a little bit short on room here, but let's just add it up. 100,000 plus 30,000 plus 150 gives us 280,000. $280,000. That's a negative, right? And so as a result, 440 minus 100,000 is 340 minus 80 minus 280 is 60,000. So as a result, what do we end up with here? We have net income of 60,000 based upon this scenario where we produce all products together, all the way to the end. Okay, and 60 is higher than 30. 60,000 is higher than 30,000. So that looks like the thing we want to do, right? Okay, maybe. Because we've got one final bit here, and let's take a look at this. This is determine total net income using the results from part C, and which is what we just oh, I know. So determine which I know I'm sorry, I'm jumping ahead here. Using incremental analysis, determine which products should be sold at the split-off point and which should be processed further. So sorry about that. I got my wires crossed, and I'm going to go just because we have a little bit of limitation on board space. I'm going to go and put C up here. Okay. And I'll try to get this in here as easy to see as possible. And so we've got different products here. We've got product 10, we've got product 12, and we've got product 14. Now the question is, okay, so we had $60,000 of net income from doing all three products, taking them all the way from the split up point all the way to the completion of whatever the end point is. The question is, should we do this with all products or not? That's really the big question. And so let's take a look at these differences here. And first of all, let's just simply refer to this. The first thing we want to look at is incremental revenue. Okay. So incremental revenue. And what is incremental revenue? Well, here's where we have to say, okay, well, let's take product 10 first, and we'll do 12 and 14. If we're going to earn 190 in revenue, if we process it further versus 60,000, then incremental revenue has got to be 130,000, right? It's simply 190 minus 60 is 130. But then you need to compare that against incremental costs. Okay, incremental costs have got to be included in here, and we're not including the joint costs. Those are already we're going to incur those regardless. So that's not even really the issue. The question is, do we do 1, 2, 3 of these, whatever the case might be? And here, the cost to process further is 100,000. This is not 100,000 for the joint cost. This is 100,000 to produce this product. Keep on producing this product. And as a result, we end up with what here? We have incremental profit of 30,000. Sorry, my phone's going off here. So, all right, so we have incremental profit here of $30,000. Okay, so incremental profit, incremental net income. We'll just call it net income here. Incremental net income is going to be $30,000. So it looks like we should keep on processing product 10. And so of the 60,000, 30,000 looks pretty good there. Okay. Let's take a look at product 12. It's the same situation. What is the incremental revenue versus incremental revenue once we're finished processing versus not? 35,000 minus 15,000 is 20,000. So this is a little bit less lucrative, it looks like. And the incremental cost is 30,000. That's this figure right here. So we have to figure that in. So we have 30,000. Well, this doesn't look as good, does it? Because this is a negative contributor of 10,000. So we don't like that. Okay. And so maybe product 12 is not the thing to do. In B, it looked like, hey, let's do this. Let's take all three products and we're going to double our profit if we do that, right? Because we're going to earn more revenue than what it's going to incur in terms of costs, even including joint costs. So let's do it, but maybe not. Okay, so product 12 may not be one we want to do. Let's take a look at product 14. The incremental revenue is 160,000. This is a big bump here. That's the revenue after processing is 215. At the split off point, it's 55, and so that incremental revenue is 160 against an incremental cost of 150,000. Okay. So 150,000 is the amount of incremental cost there, and so as a result, that's a contributor to 10,000. Okay, so 10,000 is the figure. So as a result, really, there are only two products that we ought to be doing that with. Okay, and so then the final and sorry, so that's essentially what's going on. So product 12 should be sold at the split off point, and the only way to know this is to simply walk through and sort of flow these out individually for all three products. And that's the way that we know whether or not we should do all three products or not. This is why accountants like to sort of put these numbers out there, throw them up on the board, on the spreadsheet, whatever the case might be, so that we can determine what we've got. And because sometimes it's not always obvious. And I think this is one of the lessons from this particular chapter segment. Chapter 14 is the idea. Sometimes we don't really know what we've got until we just sort of get into it a little bit. Okay. So that's part C. And then the other question, and then part D, which I'm going to go ahead and put down here. So I'm going to erase this. Again, the good news is you can stop and go back if you need to do that. And let's take a look at part D here and see what part D is asking. It refers back to C here. And it says, determine total net income using the results from C and explain why the net income is different from that determined in B. All right, well, so let's take a look here. So what we're going to do is this. We're simply going to say, okay, this is D. And we're going to take sales revenue, okay? And what are we going to have here? Well, it looks like we're going to simply take, we are going to process 10 further. So we're going to have 190, because we're going to take that all the way through. And when it comes to B, we're not going to do it. So remember, I'm sorry, product 12. So product 10, we're going to do it because that makes sense. Remember, product 12 is the one we don't want to process further. So we're going to take 15,000 revenue there. Okay. And we're also going to not incur the incremental cost, which is going to be a savings of $30,000. And so that's a good thing. And we'll show how that looks. And we are going to take product 14 and we are going to do that. And the revenue for that is 215. That is, we're going to take it all the way through to completion. So as a result, we end up with what? We have total revenues now 420,000. It's not as high as the 440, but keep in mind, we're going to be eliminating some costs. Now remember, we have joint costs. Those are going to be some costs, that is, there's no avoiding them. So we have $100,000 in cost there. And then what are the cost of production? Okay. Cost of process further. Product 10, we're going to process further. And that's going to be 100,000. We are not going to process product 12 further. That's 15,000. We are going to process product 14 further. And if you add those, so we're not going to take the 30,000 is avoided. Because all we're doing is we're simply going to take 100 and 150. So these are the incremental costs of this particular situation. So we do not incur the 30,000 for product 12. So we are going to have 250,000. And if we do the math here, we simply take revenue 420 minus 350,000, and we're going to end up with $70,000. You might think, wow, that's even better than 60,000. And yes, it is. I agree. 70,000 is better than 60,000. And why is it different than part B? It's because we avoided the cost involved, which were incrementally higher than the revenue involved in doing what we're doing. So, and it's easy to see where that comes from. We're only going to get 20,000 of incremental revenue if we continue to process this further against 30,000 in incremental cost. And so that's where that 10,000 comes from. Which is why if we don't process it further, we simply add another 10,000 to net income. And so as a result, it goes to 70,000. And so that's why sometimes not all products are going to go all the way past the split off point. Some are and some are not. And these are decisions that have to be made. Again, costs can change over time, and so these are all things that have to be determined. So anyway, I hope this was helpful. Again, I'll post this. Well, if you're seeing this, obviously, you know that I posted it. But if you have questions throughout the weekend, feel free to reach out to me. I'm available, and I'll do my best to try to get back to you as soon as possible. And when we come back on Tuesday, we'll start in chapter 15. We only have 2 more chapters to go. So we're nearing the end. And again, if you have questions, feel free to reach out. Otherwise, have a good weekend, and I'll see you on Tuesday.